The U.S. national debt is more than $36 trillion, and which is an all-time high in the history of America. The debt figure is inflated every day. The last time the U.S. debt was at its peak was during World War II, when military spending was too high. Most of the financial experts say that it is a ticking time bomb for the United States. The IMF also raised the red flag for the United States. And Trump's new big, beautiful bills also add more than $2.8 trillion to the United States debt over the next decade. The worst thing is that the U.S. are continuously adding more amount into the national debt. The interest on debt is almost touching the $1 trillion mark, and the U.S. has no plan for how it will pay back its national debt. The U.S. debt crosses 120% of its GDP, which is more than the GDPs of China, India, Japan, the UK, and Germany. The U.S. is again on the edge of the Great Recession. Today, we will discuss how this debt bomb affects the U.S. and the whole world. So stay with us till the end of the video. I promise that I will solve the U.S. debt mystery in a very easy way. If you have zero financial knowledge or you are uneducated, you'll easily understand the whole story. First, shortly explain the history of the U.S. national debt. It all began in 1790 after the American Revolutionary War, when the U.S. owed about $75 million. Each time the U.S. went to war, it borrowed more money. For example, during the Civil War, 1861 to 1865, debt grew from $65 million to $2.7 billion. In World War I, 1914 to 1918, debt hit $25 billion. And in World War II, 1939 to 1945, debt exploded to over $260 billion, over 100% of GDP. In the 2000s, debt climbed like a skyrocket after the 9/11 attacks, when America decided to start a war with Iraq and Afghanistan. Plus, with President Bush's tax cut, the debt went from $5.7 trillion to $10.6 trillion between 2001 and 2008. In 2008, the financial crisis triggered massive borrowing. By 2010, the debt had surged to $12.3 trillion. During COVID-19, the government sent out stimulus checks to help with unemployment and health support. This pushed debt to over $27 trillion by the end of 2020. As of 2025, the U.S. national debt is over $36 trillion. It keeps growing. 70% of the U.S. national debt is owned by U.S. local citizens like us, banks, pension funds, and the U.S. Federal Reserve. The remaining 30% is held by foreign countries like China, Japan, the UK, etc. We will briefly discuss the history of the U.S. national debt in some other video. What is the national debt for the sake of understanding the whole story? First, we need to understand what the national debt is. In a simple world, national debt is the total money a government owes because it spent more than it earned. For example, the U.S. earns $100 billion from taxes in a year, but it spends $120 billion on things like building roads, paying salaries, giving pensions to retired people, buying military equipment, and paying interest on debt. The U.S. government spends $20 billion more than it earns. To cover this gap, the government borrows $20 billion by selling government bonds to the local people and businesses, and banks, investors, and foreign governments. This $20 billion is added to the national debt. Whenever the government needs money, it doesn't go to a bank like regular people do. Instead, it asks the local public to lend it money. People, businesses, and big investors can lend money to the government by buying special papers called notes, treasuries, or bonds. These can be bought from a bank, a broker, or directly from the government. The government promises bondholders that it will return their original amount plus interest by the maturity date. For example, if you give the government $1,000 today, it promises to pay you back in 10 years. As a thank you, it also gives you $30 every year as interest. After 10 years, you get your full $1,000 back, and you've earned a total of $300 extra as interest. The interest amount is also known as the yield. In the case of U.S. investors, they're ready to buy those promissory notes and bonds at a low yield, for example, 3%, because the US is a stable economy and investors also trust their money is in the right hands and the US economy is not going to collapse. But if the government frequently issues bonds and the government also has a large amount of debt in their balance sheet, then investors also doubt and avoid purchasing government bonds with low yields. So the government issues high yield bonds, for example, 6%, to attract investors and fulfill its money needs. This means if you buy the bond, then you will enjoy the high interest payment on your principal amount. Things got worse here because if the government bonds are the safest way to earn money and enjoy high yields, then investors stop putting their money into risky things like the stock market or loans for homes and cars. Investors prefer to put their maximum money into the U.S. bonds because, as we discussed earlier, U.S. bonds are the safest investment option in the whole world. They also give the same return without any risk of losing money, whereas the risk is involved if you choose other investment options like the stock exchange or invest in real estate and stop depositing their money into their bank accounts. As a result, banks and lenders also have to raise interest rates for regular people, which means it becomes more expensive to borrow money for things like buying a house or a car. So when the government raises the yield to attract investors, it also causes higher interest rates for everyone, which can slow down spending and hurt the economy. Now, the U.S. economy is very badly stuck in a debt trap. It needs more debt to pay their interest amount on an existing debt, because if the U.S. needs more debt, then their new debt package is more expensive than their previous one because of high yield, and the interest on debt is also growing like the snowball effect. If the country's debt amount is too high, like the United States, then it mostly doesn't repay their previous debt on time and borrows more money on high interest rate to pay their previous debt and interest on debt. This cycle also increases the default rate, and most of the credit rating agencies like Moody's downgraded the country, like they downgraded the U.S. since 2011. The U.S. government also sets the debt ceiling to control borrowing. It's just like a credit card limit for the government. In simple words, the maximum amount of money that the United States government is legally allowed to borrow to pay for its existing obligations. But Congress has raised the debt limit 78 times since 1960. How U.S. able to pay back its debt? Now we discuss the way countries use to repay their national debt. The first and most effective way is economic growth. When the U.S. economy grows, people earn more and businesses grow. More taxes are collected without raising tax rates. This gives the government extra income to manage debt without making harsh cuts or big changes. After World War II, the U.S. had debt levels over 100% of its GDP, but it didn't pay off all that debt. Instead, the economy grew rapidly and the debt to GDP ratio dropped naturally. Use tax revenue to repay the debt. The U.S. collects taxes from individuals, businesses, and imports. A portion of this income goes toward paying interest on the debt and repaying maturing treasury bonds. In 2023, the U.S. government collected about $4.4 trillion in total tax revenue. Out of this, around $659 billion was spent just on interest payments. The government needs to spend their tax revenue efficiently and stop giving tax cuts to the billionaires. Issuing new debt to repay your previous debt is a dangerous way to repay the national debt. When older U.S. Treasury bonds debt mature, the government sells new bonds to pay off the old ones. This keeps the debt cycle running without missing payments. In 2022, the U.S. issued over $20 trillion in new bonds, not because it had added that much new debt, but to replace and refinance existing debt. Mild inflation is the way used to repay the debt cheaply. It means money loses a bit of value over time. This helps the government repay debt in cheaper dollars. If the U.S. borrowed $1 trillion 10 years ago and there's been 2% inflation each year, the real value of that debt today is much lower. Spending cuts and budget reforms are a rare way to repay the national debt. Sometimes the government tries to cut spending on certain programs or subsidies to reduce the budget deficit. If the deficit shrinks, new debt slows down. In the 1990s, under President Bill Clinton, The U.S. had a budget surplus, more income than spending, for 4 straight years, 1998 to 2001. The last time that happened in modern history. That extra money was used to reduce the national debt. How U.S. debt will affect the whole world. The U.S. national debt crisis will not affect the United States. It also affects the whole world. The U.S. dollar is the global reserve currency, meaning many countries use it for trade, store it in their central banks, and use it to buy oil, gold, and goods. If the U.S. debt grows too big and shakes global confidence, the value of the dollar could fall. A weaker dollar affects global markets because almost every country uses dollars in some way. For example, if the dollar drops in value, oil prices, which are priced in USD, can rise globally, increasing costs for everyone. Global markets also react to the U.S. debt problem. If investors fear the U.S. is heading toward a default, unable to pay its debt, stock markets around the world could crash. In 2011, when the U.S. nearly hit its debt ceiling, markets panicked worldwide, and the U.S. credit rating was downgraded. When global markets shake, developing nations often suffer the most. Their currencies fall. Foreign investment pulls out. Their own debts, often in dollars, become harder to repay. For example, if the US dollar goes up, countries like Pakistan or Argentina will find it harder to pay back their loans because everything becomes more expensive for them. Thanks for watching it till the end.